The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Tech outperforms, defensive stocks lag as the risk-on rally rolls on. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking off to the closing bell right here in the U.S. And what a move over the last 2 days.
It's a 2-day rally. It sustained itself.
It has. Yeah. And the question is, do you go even farther from here? We'll look at technicals in just a moment, but the S&P a full 1 percentage point higher. Now, remember, the intraday closing level is 61.47. So you're definitely off that level, but many say that's kind of the next stop of where we go. Everything else is as expected. You have the VIX lower, you have crude higher, you have the dollar lower. The one asset that's not being able to capitalize on that rally from yesterday, Romaine, that is the U.S. dollar.
Interesting, too, when we talk about today's market gains really being driven actually by that CPI report that we got this morning, a soft inflation report. You saw that in futures, which flipped from red to green immediately after that data came out at 8:30 a.m. That data showed a pullback in airfare, hotel, apparel prices. The cost of groceries declining for the first time in almost a year, and new car prices, they were flat, defying a lot of expectations of a tariff-induced pickup. Now, the more positive sentiment around tariffs is important as well. After all, that, of course, was the anchor of yesterday's monster gains. And while this 2-day 4% S&P rally is still light on conviction, you can feel the FOMO starting to build. A Bank of America survey last week showed fund managers were net 38% underweight U.S. stocks, the most in 2 years, exposure so low that a sustained rally will leave bearish positions sitting on steep losses. And because of that, Goldman strategists who cut their S&P forecast twice in March cautiously lifted their 3-month target today to 5,900, which is where we're at right now, and they see a path to 6,500 over 12 months. John Kolovis over at Macro Risk Advisors reading the technical tea leaves and seeing no major upside resistance until at least 6,100. But Larry Fink at BlackRock says we still need to see more of a tamp down in policy uncertainty to get more investors off the sidelines.
In Europe, there's $12 trillion of money sitting in bank accounts in Europe. In the United States, there's $11 trillion sitting in money market funds. When there is that uncertainty, you're going to keep more and more money in cash, and that's what we've witnessed.
And Larry Fink speaking over at that big summit in Riyadh. And look, I mean, he points out something that's really critical. A lot of folks are on the sidelines, but that shouldn't throw cold water on the fact that this is a market now that is green on a year-to-date basis.
Green on a year-to-date basis. Who would have thought that? And now the question is the pain trade really now to the upside? Here's a technical illustration of what Romaine was talking about. Okay, so you got the orange line here is the 50-day moving average, then the yellow line is 100-day, and the purple line is the 200-day moving average. Now, what we saw back in the middle of April when we wound up hitting that low was you saw the long-term moving average above the shorter term, and that really propelled the bull market higher. And now we're very much at a similar crossroads here. It's called a golden cross, by the way, where the longer-term average could go higher. And you see this enormous gap up. Now, some say that needs to be filled. Others say maybe not. And we can keep adding to that rally, and as you pointed out, until we hit that 6,100 level. The question, though, becomes, does the micro really support that in the form of, say, earnings?
Good question. Garrett Melson joins us right now, maybe potentially giving us an answer. He's portfolio strategist at Natixis Investment Managers Solutions, helping us kick you off to the close here on this Tuesday afternoon. And that really is the parlor game right now, Garrett. I mean, we talk about, I guess, a shift in sentiment, but that doesn't necessarily mean that, well, the damage is over.
Yeah, I mean, it certainly has been a pretty dramatic shift in sentiment over the last couple of days. And to be honest, I think that's really been the story of the rally off the lows. It's been a function of cutting off that crisis tail that really emerged back in the wake of Liberation Day. So I think it's certainly been a justified rally. And obviously, a lot of that optimism has been a function of, de-escalation on the trade front. But while I think the earnings damage is likely to be a lot smaller than we had anticipated or feared early on, I do think you're basically round tripping to an environment where, maybe the market might be somewhat underappreciating those linear cooling risks that are still underway in the economy that have kind of been pushed to the side over the last couple of weeks.
Well, what exactly are you sort of, I guess, keeping an eye on? I mean, we got that inflation report today, and I know it's just one report, but it does seem to suggest some degree of moderation when it comes to inflation. So maybe that's one less thing to worry about. We're going to get in a couple of 2 or 3 weeks' time another labor market report that is widely expected to show stability in the labor market as well.
Yeah, I think you hit on a key point, which is the underlying trend in inflation was certainly encouraging as we entered into the trade escalation. So that remains the case with the April data. I think a lot of people were concerned that you might start to see some early signs of the trade disruptions, and now that that's really cooled off, maybe we don't really see a whole lot of impact in some of that hard data, at least from a price perspective, and simply reducing those upside pressures on inflation from the function of or perspective of the Fed, removes a lot of that tension that emerged within the mandate. So I think that's at least something to take some solace in, which is it makes a little bit of a cleaner backdrop for the Fed. But I think at the end of the day, you're still looking at an economy where nominal incomes continue to cool off, and I think that's really the key of the issue here. Is labor markets are still okay, but under the surface, you continue to see some red flags that suggest the direction of travel is cooler. And I think that's just going to lead to a dynamic where as long as the Fed continues to kind of wait for evidence of that in the hard data, that just means they're going to remain on hold, and that translates to continued passive easing, kind of exacerbating the slowing in the economy.
I mean, on the flip side, you could say because inflation isn't necessarily taking off and we do get some trade deals, that you actually could see a Fed cut earlier because inflation isn't a problem. I mean, look at what happened to the front end earlier today after the CPI number. How does that fit into your case?
Yeah, I think it pushes off the next cut. Markets have certainly repriced pretty aggressively. We're pricing in just 2 cuts for the year and really just pushing that start date of the next cut out until September. And I think that kind of makes sense. Tying back to the rally we've had just the last couple of days in markets, it certainly might be the pain trade that we continue to push higher here. And maybe it's a story of basically we're setting ourselves up for a little bit of another growth scare where the Fed just doesn't see enough in the data to really be pushed along to cut more aggressively sooner. And, I think what's still looming out there, and that's going to come back into the narrative a lot more over the summer months, is what is playing out in Washington, not on the trade front, but coming out of Congress in terms of the reconciliation bill. So there's still, I think, enough uncertainty there where the Fed's willing to just continue kind of sitting on the sidelines and watching the data unfold, because from their perspective, they still think things are still on pretty solid footing.
So what is the durable growth story? And you mentioned the tax package. Does that help support a potential durable growth story?
Yeah, I think that's the tough part right now. I think that really it's hard to get a strong case put together for why growth should surprise to the upside from here. Again, you start with the labor market, but if you go out to all the other pillars of growth, housing is still kind of stuck in mud. Rates are just not working for mortgages right now. And if you take a look at completed inventories, they're still rising. State and local budgets, I think, are the bigger story on the government spending side. Those continue to contract, and that's probably going to be a modest headwind on employment in that sector. And when you take a look at CapEx, sure, AI is still doing just fine, but outside of that, now you have incremental headwinds in the oil patch, and confidence has taken a pretty meaningful shock in here. Uncertainty might be lower, but I don't think it's enough to really firm up hiring plans and CapEx intentions in the near term. Just take a look at the NFIB survey this morning. So that kind of creates a backdrop where until you actually see the Fed moving, that's, I think, what's going to really start to help to support a floor in here. Obviously, tie in the package coming out of Washington. If that does surprise to the upside in terms of outright deficit spend, okay, well, now you start to have a little bit more of a federal government impulse. That's helpful. But I think between now and then, towards the end of the year, I think the bigger story is going to be one of underlying cooling that the market eventually is going to have to grapple with.
So when we talk about portfolio allocation, then, Garrett, that means that you're going to stay defensive, or at least that's your general recommendation?
I think right now it's increasingly hard to fight this tape. And as I mentioned, I think it's going to take some time until you actually see that slowing come through in the data, right? Think about the timeline for the Fed. That passive tightening is going to continue until that first cut. And you just don't have a lot in the way of clean reads of that underlying trend in the data, right? You're still going to have a pretty meaningful surge in import data probably over the next couple months, whether that's just a function of catching up or maybe additional front running just to reduce some of those risks if we do see escalation. That's all just adding some noise in here. So right now, when it coming from a point where sentiment was still very bombed out, we've recovered, but I think there's still kind of a bearish leaning in the sentiment data, and a lot of the positioning suggests you've not seen really the real money and even systematic strategies relever in here. So I think the pain trade, at least in the near term, is maybe to the upside until you start to get towards the end of the summer months, and that might be where we start to see some of those cracks emerging in the hard data.
Garrett Melson, portfolio strategist at Natixis Investment Managers, kicking us off to the close here on this Tuesday afternoon. afternoon. He was just talking about the sentiment data, and we got a big one this morning. Small business sentiment still dour, declining for a fourth straight month. Carol Roth going to be joining us in just a second to talk about the landscape.
All right, plus we're going to talk to the CEO of a company with major trade tension exposure, a discussion on how Generac is coping with China and metals tariffs. We're going to break that down with the CEO, Jagdfeld.
And we're going to hear from the CEO of a company being affected by Trump's drug pricing plan. Why Currax's George Hampton is calling Trump's pharmaceutical executive order misguided. That conversation coming up in just a bit. Stick with us. This is The Close on Bloomberg.
U.S. small business sentiment declining for a fourth straight month in April as firms grow more downbeat about the economic outlook and sales prospects. 6 of the survey's 10 components decreased, led by a slide in business condition expectations, as well as a pullback in job openings. Let's get some more insight into what's leading small businesses with expert Carol Roth. Carol's also a former investment banker and author of the book You Will Own Nothing. Carol, it's great to get your perspective on this. The data actually wasn't as terrible as one might think. In fact, it was insurance costs that actually pushed higher. How would you rate small businesses right now?
I think it's been a challenge for small businesses, and you have to remember when you look at the NFIB survey that is backward looking. And April was a chaotic month for everybody, but especially for small business owners. If you were a small business that had part of your supply chain or all of your supply chain abroad, or perhaps maybe depended upon a supplier, with 145% tariffs, you basically ground to a halt. And so while 30% is still a very heavy lift for small business, that was something that basically stopped a lot of businesses. And then you had all of the chaos in the market. And while Main Street is not Wall Street, there's certainly the secondary effects. When you have, the wealth effect from people's 401ks going down, uncertainty about whether you can hire or not, it creates a very big challenge. And that does find its way down to small businesses.
What we do seem to know, though, is the floor. And the floor seems to be that blanket 10%. And clearly, the worst case scenario for tariffs does wind up coming down with at least 90-day reprieves. Does that give small businesses more confidence?
Well, I certainly hope that is the floor and that things don't change. When you have a 90-day pause and you have a wild card in terms of this administration, they've said that this is going to go on for 90 days, but they could change it at any point in time. And we've seen, these kind of unexpected things happen. So I think that that's an issue. It's also very difficult, for any business, but particularly a small business, to plan in 90-day increments. So even though there is a theoretical floor and ceiling, as you said, Alex, it does make it more challenging. The small businesses I've been talking to are in a rush right now to try to get as much done as they can within that 90-day window and see how it goes from there. But the hope is that we are, in de-escalation and that things moving forward will only be better, not worse. And I think that will really save small businesses that were, frankly, on the brink in many cases of having to go out of business if something wasn't decided pretty quickly. So we're pretty relieved about that on the small business front.
Still challenges for them. And I am curious just about the overall market environment, economic environment, I should say, and these sort of dour sentiment readings, not necessarily on existing small businesses, Carol, but for those entrepreneurs out there or budding entrepreneurs who are thinking of starting a business. We've seen business creation in this country effectively crater over the last couple of decades. And I am curious if this actually exacerbates that.
Well, I think there was a lot of optimism about the Trump administration from small businesses and those would-be entrepreneurs that you're talking about, Romaine, in hopes that we would get more clarity on the tax cuts, hope that we would get maybe some deregulation, that it would make it easier to be a small business, even something as simple as rolling back some of the constraints on independent contractors and gig workers that allow small businesses to work with staff more flexibly. So I think all of those things were very positive positive, and that's where you saw that big optimism swing in, kind of last year. But then when you have something like this that comes out of left field, particularly after small businesses have been beaten up by COVID mandates, by inflation, and so on and so forth, it does make you pause as somebody who's an entrepreneur. Now, entrepreneurs are always optimistic. They're always going to think that, that the best case is ahead and that they can do it. That's what an entrepreneur is. Yeah. But it does create just one more potential hurdle, and we want to remove those hurdles for entrepreneurs.
Well, what about, like, if you have a company out there, a small business that's just starting up, and particularly a goods business? I mean, the playbook, at least for the last, 20 years or so, was, if you were going to manufacture something, you sort of reached out to some, random person in China. Hopefully you got the right bid. Hopefully you got the right mold. You went to town, got your shipments, and sold them. How reliable is that even going to be? Even if there is some sort of trade deal struck, I mean, would you sort of bank your entire inventory on that relationship?
I mean, I guess the good news for entrepreneurs is that we do have the majority of them in the service business. Not to say that they may not have some level of exposure to what's happening abroad, but that's certainly a path that I think more entrepreneurs are going to think about. But those who are considering goods, it is very risky for many reasons for them to pursue, maybe a relationship with China. But frankly, even other nations, when you think about what happened on Liberation Day, all of the companies that had been manufacturing in China and try to decouple to other nations, they also got crazy tariffs. And then, that was mitigated eventually. But they did what they thought was the right thing and were still punished for it. So I think it's really important to move past this and to give a clear message to entrepreneurs and small businesses saying we're going to do the things to remove barriers, to deregulate, to make it easier for you because you are the backbone of the economy. And if we want to grow the GDP, and by the way, with the debt to GDP that we have, we need to grow the GDP, that we are going to need small businesses to participate. And we've heard Scott Bessent say the same thing. Absolutely.
All right, Carol, great stuff. I have to leave it there. Carol Roth, leading small business expert there, and of course the author of You Won't Own Anything. Steve Madden shares, keeping an eye on them, moving higher by about 2% on the day, part of that tariff reprieve. We're going to speak to an analyst who believes that the trade truce between the U.S. and China is a step in the right direction that will benefit the shoemaker. That's coming up next in our top calls. This is Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Caterpillar. Baird upgrading the construction machinery company to outperform and raising the price target to $395. The analyst says the easing of tariffs between the U.S. and China, a major positive, and he expects an earnings reacceleration in 2026. Shares up about 3.5%. We should point out up 11% over the last 4 days. Next up, Stanley Black & Decker. Barclays upgrading to overweight and boosting the price target by $21 to $90. After initially saying Stanley was one of the most vulnerable companies to tariffs, the analyst now sees a better outlook for the tool maker as trade tensions cools. Those shares up about 2% on the day and 25% over the last 4. And finally, let's take a look at Steve Madden. Williams Trading stepping up their rating to hold and almost doubling the price target to $31. The analyst says the footwear maker is yet, yes, another beneficiary of the trade detente, and says that the 90-day tariff pause should drive better revenue growth than expected. Those shares higher by about 2%. Now, back to the highest level since, well, April 2nd. Those are our top calls, and we want to stick with that last one because the analyst behind it joins us right now. Sam Poser is equity analyst over at Williams Trading. And Sam, when we talk about this reprieve, a 90-day reprieve, maybe it turns into something more permanent. Give us a sense of how you sort of quantify what that impact could be on Stephen Madden.
Well, Steve Madden's making about 50% of their inventory right now is made in China, and they're reducing that very, very quickly. But with China being so important to them, having 145% additional tariff was making it, almost a non-starter to bring product into the country. So now at 30, while it still has some, there's still some headwinds there. It's nowhere near what it was, and it's something that's more manageable. And by the end of the year, they're going to have, they're going to reduce their exposure to China significantly. Their core brands. Oh, sorry. Go ahead.
Have they been doing that already? I mean, I saw in your most recent note you highlighted some of the countries that they have exposure to, and with regards to their supply chain, countries that aren't named China.
Correct. They have been, but they moved, and they had spoken at the beginning of the year. Prior to all of this, they intended to have China down, in the 40% range. That number has come down significantly since then. So, and for the core Steve Madden women's brand and for Dolce Vita, their two largest brands, there's a lot of focus on both Mexico and Brazil. And then with some of their athletic fashion shoes, they're moving. That's going to go to Vietnam and Cambodia, but they're still going to have exposure with some of their Madden Girl and other styles that are sort of that more of an opening price point branded product, which is the stuff that's going to be the last to leave, I think.
Yeah. But either way, there's still going to be some blanket tariffs, 10% on all imports in general. And then based on country, it could be higher. Just look at where it's happening with China. So has that been digested in the stock yet?
So, we don't know what's going to happen on July 9th or August 15th. So there are certainly some concerns, but that would be true for absolutely every company. The difference with Steve Madden is that they turn their inventory over 5 times a year. It used to be faster, but as they've built their direct-to-consumer business, it's slowed down a little bit. But that's still, almost double most other companies. And what that means that they need more inventory now. They run with like 10-ish forward weeks of supply. So they need more inventory today. Other companies are running have a lot more leeway. Plus, they want to have the newest items out there in front of people. Not only does the pause on the tariffs help, but also it takes pressure off of a lot of their major customers and might make them slightly less conservative about how they're planning their business going forward as well. So, there's a demand side to this, and then there's a supply side to this. And I think what happened was that, there was sort of a collective sigh with this pause on the tariffs that now the consumer is going to be less impacted than they were in general. And because of the exposure that Madden has had to China and the need to turn and how fast they turn goods, it becomes sort of a larger relief to them than many others in my coverage.
All right, Sam, thanks a lot. We really appreciate it. Sam Poser, equity analyst over at Williams Trading. We appreciate that very much. Taking a look at the markets, though, we are still around the highs of the session. The S&P is up 1%. You got the NASDAQ up by about 1.8%. When you take a look at a company-by-company level, Romain, talk about the uncertainty. Goldman Sachs upgrading stocks, but remember in March, they had to downgrade it twice. So there's been a lot of whippy action.
Yeah, and we should point out we're still nowhere near those highs that we had back in February. Still need a couple hundred points to even get close.
Yeah. Will we get there? All right, coming up, we're going to speak to another company impacted by tariffs. Aaron Jagdfeld, the chairman, president, CEO of Generac, will be joining us. This is The Close on Bloomberg.
Over the weekend, we reached a breakthrough agreement with China. Both outstanding deals. China's agreed. We have to get it down. We have to get the little details down. Scott, you're going to work on that very hard, but China's agreed to open up to the United States for trade and everything else. But they have to do it, so we'll see what happens.
3:30 p.m. here in New York, after 8 p.m. over in Riyadh. That was the president of the United States speaking at that U.S.-Saudi investment forum just a little while ago, making the investment case for the United States of America.
Yep, and saying that that the Saudis would invest about $600 billion in deals. Now, that was already previously announced and reported, but maybe that could wind up going up to $1 trillion and could be a big boost for some of the companies that were there.
I think so. I mean, and at least, based on what we've heard publicly, it does appear that there are some deals getting done. And the idea is that maybe this sort of feeds into the broader issues with regards to our trade policy, our tariff policies, and whether there can be a recouping if our relationship with China doesn't improve?
I would think that running a company on hopefully would be very stressful.
I would not want to be
I would not want to do that. Should we ask someone who does do that?
I think so.
Let's do that. Okay, joining us is someone who leads a company that is exposed to some of those tariffs, particularly with China. Aaron Jagdfeld is chairman, president, and CEO of Generac, a global energy technology company. If you have a house, you probably have a generator, and it probably comes from Generac. Good to see you. Thank you for joining.
Thanks for having me on.
You guys highlighted on your last earnings that tariffs could be a hit. We've now since had that 90-day reprieve. Is your business outlook changed?
I wouldn't say it's changed since yesterday dramatically, right? So
you never know.
You never know. And now we have 90 days to figure out what comes next. So we still are watching very closely. Certainly, all of the trade policy impacts to our business have been, we've tried to push through some pricing. We've tried to do some things to offset. But it's difficult to do anything in 90 days. I mean, 90 days is a very short period of time for businesses to react, but we try to do our best with that.
Are you rethinking your supply chain at all?
We have been. That all started really going back to the first Trump administration with the 301 tariffs, and then when COVID hit, obviously the importance of resiliency in your supply chain became very apparent. So we've been trying to create a more resilient supply chain over the last 5 or 6 years, and I think that's helping us now. I mean, we're able to react more quickly to some of these changes, even though 90-day periods are very short blocks of time. We're finding ourselves in a better position than I think we would have been if this were happening 5 or 6 years ago.
Is there a sense, though, I mean, longer term, when you talk about what your supply chain is going to look like, do you have any sort of visibility into what that's going to look like?
We do. We're going to continue to reduce our dependence on those higher tariff countries. So China is an example. So today, less than 10% of our supply chain comes from China, but that'll be less than 5% in 18 months, based on plans we've already had in motion, and this will obviously accelerate those. And where we go next is kind of the question, right? So there's going to be winners and losers as companies like ours rotate their supply chains into different countries. India has always held a lot of promise as a supply chain and as a trade partner for the U.S. I think that'll probably start to come to fruition more meaningfully in the next year or two.
Does it worry you at all, though, that maybe the trade fight that we're having now with China could shift to other countries? I mean, obviously, we have a relatively good relationship with India, but as companies sort of look for other countries to sort of do business with, is this going to be kind of that whack-a-mole where you're just kind of trying to stay one step ahead of the president?
I think that certainly is a risk, given the reciprocal trade formula that was built on the deficit, that you have a trade deficit with a country, that country could end up with some kind of tariff to help equalize the trade between those partners. So if everybody runs for the same door and everybody runs for, say, India or one other country, then that might be a risk. I mean, that's something we have to watch. But I would say this, that as a country, if our big trade partner became India as opposed to China, that's probably better for the U.S., I think better for India, better for the world perhaps, in terms of just being partnered with a democratic country as opposed to one that's not democratic.
Let's talk about the demand side. So one thing that's different this time is data center demand. How are you playing in that space?
Yeah, so we kind of two ways, right? So the indirect play on data center demand is as data centers come online, they use a tremendous amount of power, and that is having a destabilizing effect on the grid. So all of that demand side equation, that load growth that utilities haven't had to deal with in the last 25 years, they have to figure out how to accommodate that. And we just believe that destabilizing effect is going to show up in more power outages. And we're seeing the data show that. So that's one side of it. And obviously our backup power products are a great way for businesses and homeowners to protect against that happening. The other way, though, is to sell those types of products directly to the data centers for their own backup needs, right? So they need very, very high levels of reliability. So 4 and 5 nines of reliability. Their uptime guarantees for their customers are really critical for them. So it's mission critical power. And we provide products for that space as well. And right now, those products are in high demand.
Talk about those products in particular. How much are you investing in providing those products? Because this is a nascent market, right?
It is. It's a growing market, but it's still small. We're in the early innings of the capital cycle here that's going on. We built a new plant in Wisconsin. We're close to where we're headquartered. That was about a $65 million investment for us last year and into this year. Just opened that plant up. We'll produce some of these new products there, as well as opening up some capacity in some other plants. And then we've another $65, $70 million of equipment, to outfit the plant and to be ready to produce.
I am curious. I mean, the majority of your sales right now are here in the U.S., are domestic. Are there any plans to maybe expand a little bit more internationally?
Yeah, we have a really good international business based in Europe. They also have, we also sell in Asia, we sell into Latin America, and so it's a very global business that way.
Yeah.
Still, 85% of what we do is in the U.S. market.
Are there some of the issues here in the United States with regards to power reliability? Is that also an issue in some of those other markets?
I mean, look at the example of Spain and Portugal. Just happened, right? So, I mean, obviously, this is the type of situation. Lower power quality and higher power prices are, we think, megatrends that are impacting not only the U.S. market, but all markets across the world.
How much does it cost to build one of those big generators for a data center versus one for my house?
Yeah, a single generator for a data center could be $1 million for one single unit, correct.
Whew.
Yeah.
So how hard is it to build those? So do you have to contract them before you build them? Or you
we do, yeah. So you definitely, there's a longer sales cycle for those products. There's a development cycle that's on the front end where the building is being outfitted and the site is being prepared. Those products would then be ordered, and we'd have a lot of visibility to 40, 50 weeks worth of an opportunity before it became something that we put together and sent out into the world. But
yeah, I'm curious about the DOE grant that you got, the $200 million grant from the Department of Energy here in the U.S. to help sort of bolster the situation in Puerto Rico. Have you gotten those funds, and if so, have you started to deploy them?
We have started to deploy them. The funds are flowing. And I would just say this about that program. I mean, it's a very important program aimed at low and middle income households. People who are the most vulnerable when outages happen, people who are a lot of times medically compromised. And so, where it's not an option to be without power, right? You've got all types of medical devices in the home. They've kind of moved into the home today, oxygenation. You've got at-home dialysis. You've got people just mobility issues, things of that nature. Very important program. Puerto Rico, obviously well documented the grid challenges in Puerto Rico. Had another big outage in Puerto Rico about 10 days ago. So, and our products worked flawlessly. We're rolling those out over the course of this year.
Yeah. All right. Great stuff, Aaron. How's Waukesha these days?
Waukesha's warming up.
Yeah. Is it? All right.
Yeah. What is it, 40 now?
Yeah, it's close to 40. The ice is thawing, right? The snow's melting, so it's all good.
Well, that's warm for Wisconsin this time of year. Aaron, great to have you. Aaron Jagdfeld, Chairman, President, and CEO of Generac. All right, coming up here, we're going to take a look at one of the big decliners on the day, and that is United Health looking under the weather, a 17% drop in the shares. This after a surprise change in leadership at the top of the firm. That's coming up next. It's part of our Stock of the Hour. This is The Close on Bloomberg. All right, it's time now for our Stock of the Hour. Taking a look at shares of United Health, down 17% on the day. 6 straight days of declines. This came after a bit of a shock when it comes to their earnings, a bit of a shock when it comes to a pulling of their guidance, and a bit of a shock when it comes to their CEO stepping down. Joining us right now to discuss is Bloomberg's John Tozzi, who covers this company for us here at Bloomberg. Obviously a surprise in the change in CEO leadership. I want to start with the earnings themselves and the increase in medical costs and why that was a surprise both to the company and to the market.
Yeah, and so just to be clear, United Health reported earnings a month ago, and those missed estimates, and they lowered their guidance at that time, and that was sort of not unprecedented, but first time in decades for this company. Right.
And now 3.5 weeks later, they're saying that we can't even stand by that guidance.
Pulled their guidance entirely and replaced the CEO. So,
so what happened?
Well, so they said in April that they sort of noticed escalating medical costs exiting the first quarter, right? So this sort of trend that was increasing beyond their expectations, and they had already priced for accelerating medical costs. So whatever was happening was beyond what they had prepared for, and they seemed to think that they had a handle on it in April, but in the intervening month, whatever new data they're looking at shows that it seems like it's worse than they were preparing the street for when they lowered their guidance a month ago.
And so just to be clear, so the CEO, Andrew Whitty, he leaves. They cite personal reasons.
Correct.
The old CEO, who I think was still chairman of the board, he's back.
Yes, Stephen Hemsley.
He's 72 years old.
Yes. And
okay, go ahead.
He was the CEO for about a decade, starting in I think 2006. Who sort of built United Health into the enterprise it is now, right? So he's did a lot of the growth and deals. to expand into pharmacy benefits, to expand into care delivery, this sort of diversification that United Health was really the first out of the gate for in the sector, and that other companies then tried to replicate to some extent. That strategy was his. And what he told investors this morning is that he still thinks that the company's strategy is the right strategy, that has the right assets, the right portfolio for this moment, but that they basically need to execute better.
So I'm looking at the S&P, and 8 of the worst 10 performing stocks are all in the healthcare-ish space. Now, some are drug makers like a Merck, but then you got Humana, you have CVS Health, Centene, Molina Healthcare, Elevance Healthcare. Like, is this all down on the same idea that medical costs are going to rise and it's going to squeeze these guys?
Yeah, so all the entire health insurance sector is selling off on this news. That is exactly what happened when United Health reported earnings a month ago. They were the first of the group to report, and everybody sort of thought it was a bellwether for the rest of the sector, and that other companies were going to experience the same sort of unexpected medical costs. Now, their earnings were largely fine. They did not, most of those companies did not experience the same increase that United Health reported. So why they are selling in sympathy today, I think the street is still asking the question, well, is this going to emerge later on?
Yeah, like it did for United. Right, and also, is it United specific or is it broader, and with more downgrades to come? Really great stuff, John. Thanks a lot, John Tozzi of Bloomberg, joining us there. We're about 15 minutes away from the closing bell right here in the U.S. So you have healthcare stocks getting hit really hard. You know it's doing well? First Solar.
Yeah.
That's kind of a shocker, but sort of the new rules, not as bad as thought from the GOP bill.
Yeah, I mean, definitely a winners and losers kind of day. And we should point out, when we looked at yesterday's rally, which was a relatively broad-based rally, today is not necessarily that. About half the stocks in the S&P still lower. Of course, healthcare dragging it down. And
driven really, though, by tech. Jason Pride, Chief Investment Strategy over at Glenmede, will be joining us.
And I do think you're basically round tripping to an environment where, maybe the market might be somewhat underappreciating those linear cooling risks that are still underway in the economy that have kind of been pushed to the side over the last couple of weeks.
Garrett Melson, portfolio strategist at Natixis, kicking us off to the close just about 50 minutes ago. 5,900 on the S&P 500 right now. Alex Steele, right around the highs of the day.
Yeah, exactly. Staying around the highs of the session. Some technical analysts are talking about the next stop after the big gap up from some moving averages is going to be the record high that we saw at 61.44. But on a fundamental basis, you have to ask the question, what are the growth drivers really going to be when there is still so much uncertainty?
Yeah, and this does kind of feel like one of those more of a technical rallies. And of course, you had some great notes out, including from the folks over at Goldman, as well as over at Bank of America, talking about this idea of a potential kind of a bear squeeze, the idea that you have a lot of people that were positioned for the worst case scenarios. They're going to have to unwind some of those positions, and that could put more upward pressure on the markets.
And mechanical buying, et cetera. But also oil getting a nice bid, and you're seeing energy stocks really outperform. That could be fundamental. President Trump was talking in Saudi Arabia about being much more aggressive when it comes to Iran, hoping they get a deal, wanting to get a deal, but really it's up to Iran at this point. Yeah, the main ETF tracking a lot of those oil and gas companies up 4% on the day. The XOP as the S&P barrels towards a gain of about 1% on the day, adding to the 3% gain yesterday. Jason Pride joins us right now, Chief of Investment Strategy and Research at Glenmede, joining us from our office in beautiful Washington, D.C. And I guess that's kind of fitting, Jason, because the recent moves that we've seen in the market to a large part have been driven by what's going on in D.C. When you look at this upside that we've seen over these last couple of days, does that actually speak to a fundamental shift in investor sentiment and in the investment case, or is this just more kind of that bounce off the bottom, a technical driven rally?
So I think the answer to that is yes and yes. There's two kind of key changes here. Number one is we've had a kind of a series of items that were a downshifting in tariff-related items. That takes out the bottom end of the downside risk for the economy by taking things like the full reciprocal tariffs off the list, seeing the U.S.-UK negotiations, and now seeing the U.S.-China negotiations. The risk seems to be declining, and now we're seeing a lot of the economists actually come out and lift back up their expectations for GDP growth for the year. taking away the recession calls. Recession calls are looking like a lot of economists now have 20 to 40% likelihood, whereas there were a number that were at 50% plus just earlier this year amidst the largest amount of the tariff fears.
It's kind of interesting, too, that when we talk about the complexion of this rally, of course, a lot of people piling back into the Mag 7 and the other sort of big tech names, if you will. And I understand why some folks would do that. But it raises a question about this idea of whether we could see a broader rally that includes a lot of the other parts of this market.
Absolutely. And we've actually been a big proponent of this. Right now, that rally does seem to be very focused in the big tech companies. Now, part of the reason might be is some of those may have been more exposed to some of the tariff scenarios and the negotiations going on the international scale. As we look to a broader kind of growing economy, if this economy does hang in there, that participation is probably going to widen. It'll probably widen down the capitalization spectrum to other companies in the S&P 500, the rest of the market down to the small cap area. And we also continue to think that investors should diversify on a broader basis, owning things internationally, as well as owning a reasonable allocation to bonds at this point in time, earning 4.5%, roughly speaking, on the 10-year Treasury. Those are decent yields for bond investors.
Jason, what kind of questions are you getting today that might have been different from the questions that you got a week ago?
Well, the questions have gone from like big time concern about the tariffs to now kind of people really trying to figure out, okay, well, where does this all land? I think that's what's still up in the air is we don't know if we're going, at one point in time, the projections were 20% plus effective tariff rates for the U.S. after the initial announcement. Now we're down into like 14, 15 range. The question now is, are we going to go down further from there into like, closer to that 10 to lower teens sort of range at some point in time?
So based on all we know now and sort of the roadmap that we might see for negotiation with President Trump, what's going to be the advice to clients? Like, you have your strategy and just stick to it and hold your nose?
So one thing is, number one, make sure you have the right strategy for you, apportion your risks to your risk-taking ability. Number two is recognize this is not necessarily going to be a smooth line. Expect volatility. Play into the volatility. That means when markets are up a lot, maybe back off on and rebalance your equities if you're now overweight equities because you bought earlier. If markets decline, do the opposite. Actually step into them. Recognize the volatility and actually willingly allow yourself to more regularly rebalance your portfolio and take advantage of the fact that the market's just going to give you those volatilities and that sort of swing.
Where does, bonds fit into all of this, Jason? Because, that had been a big play for a lot of folks amid the volatility. You can pick up some pretty decent yield with relatively minimal risk. Is that still something you would advocate for?
Absolutely. We're actually advocating a fairly neutral risk posture, meaning equities not overweight, not underweight. That also means bonds not overweight or underweight. So a pretty healthy allocation to bonds for the average client. And the best thing about bonds is when the equity markets do experience those dips, the bonds are probably appreciating and give you that opportunity to rebalance. We've seen that recently, even amongst this turmoil. Sometimes it works, sometimes it doesn't. But generally speaking, bonds are acting as a ballast in portfolio better than pretty much anything else in equity land.
So kind of wrap this all up for us, particularly when it comes to this idea, Jason, of sort of the longer term outlook. If recession risk is off the table, if folks think that economic growth will at least be decent, not necessarily a barn burner here, does that sort of constitute the risk on, or do we need to wait for more of the data? Do we need to wait for another round of earnings season to actually feel more confident about it?
Well, first, the recession risk is not necessarily off the table. We are still sitting with about a 35% chance of recession at this point in time. It's just not the base case. And from that perspective, investors should recognize that the markets, when they're more worried about it, they're going to be lower. They're going to rally into that because the recession risk declines. But then they can actually get overextended. I would probably even argue that maybe the markets are a little bit ahead of themselves at this point in time. We'll probably see some reconciliation of that within the next month or 3 months as we go through trying to figure out exactly where tariffs are going. And then we'll have an eventual stabilization out, probably at a more reasonable growth rate as we end up in the back half of the year.
All right, Jason Pry, Chief of Investment Strategy and Research at Glenmede, counting us down to those closing bells. In S&P 500 off the highs of the day, 6 of the 11 S&P sectors in the green, and that is led in a big way by big tech.
Yeah, but we're only up 0.16% now. On the year, we faded a little bit in these last 10 minutes. But yes, we are still positive on the year.
All right, full context of everything that happened today with the whole gang coming up in just a second, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through to that closing bell with a global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Masser in the radio booth, Tim Stenovic filling in today for Matt Miller as we welcome our audiences across all of our Bloomberg platforms.
That was good.
Including our partnership with YouTube.
I did call Matt Tim.
I haven't seen this guy in a while. I don't know where he's been.
I do get a lot of people who like to write in, their listeners, their viewers. The person who gets in touch every day, Matt Miller.
I'm sure he does.
He's driving home.
He listens to us every day. He says this is his favorite show on any platform, any media.
We're not going to let him.
What about his own show?
No,
that's what he spends his time doing.
He doesn't watch his own show. Nobody watches that, do they? What time is his show on? Does
9 to 11.
Oh, I've heard.
Open interest.
Thank you. Thanks for the plug.
I'm there for you, Matt. I'm there for you.
If you're listening.
Don't plug it for him.
I'm there for you, Matt.
So much when he subs on. I'm just going to say. Hey, listen, we are actually in the green on the S&P year to date, guys. Woo-ha.
Uh-oh, cue Alex.
Barely. 1.2%, guys. We're barely there. We rolled over a touch into the close.
Look, I think that's fair to say, and we're still down from those all-time highs that were reached back in February. So yes, it has been a wild last couple of weeks. But yeah, like Carol said, pretty much flat on the S&P 500.
Green is green, I'm just going to say.
Green is green for now. Not a whole lot of move in Treasury. So you look at yields, they're just a touch higher, but barely moving. So it's an interesting dichotomy here.
You got the VIX tamped down. I guess that's a good sign. At one point, it was down below 18. Looks like that's where it's going to settle here on the day. Volatility, though, in the bond market, believe it or not, that's actually picked up. So it'd be kind of interesting to see how all of this sort of fits together. Green across the screen. Let me rephrase that. Green on parts of the screen here on this Tuesday afternoon. You can see there on the left, the Dow Jones Industrial Average is going to close in the red, down about 300 points or about 0.6%. A part of that is the big drag from United Health on the day and some of the other healthcare stocks in that average. The S&P 500, though, is going to close out the day in the green, higher by 0.7%. It's going to close just below that 5,900 level that we have been keeping an eye on, but it is going to close out the day with a year-to-date gain of just about 0.1%. The NASDAQ Composite up about 300 points at 1.6%. Similar move for the NASDAQ 100, which is now in the green on a year-to-date basis. And the Russell 2000 getting in on the action, higher by about 0.5% on the day.
S&P up 0.08%, Alex, year to date.
Okay. We made it. A win's a win. I'm just saying.
S&P 500, guys, kind of an even split-ish. 244 names, Scarlett, to the upside in the S&P 500, 257 to the downside.
Yeah, you can kind of see that reflected in the IMAP as well, which is pretty much mixed down the board. But of course, the biggest sectors, which is tech, consumer discretionary, they have the biggest gains. So as a whole, obviously there's a lot more green. Tech up about 2.25%, consumer discretionary gaining 1.4%. Energy also getting a bit of a revival here as oil prices continue to recover. They're up 1.3%. The laggards on the day, healthcare down almost 3% as a group.
All right, let's get to some of the individual gainers and check it out because some of them kind of hitting significant milestones to some extent. Let's go to Coinbase because its shares, they are up almost 24% here in today's session. We know what the news is.
You can round that up. It's 23.97, Carol.
I said 24%. Okay. All right, so a big gain. This company's going to join the S&P 500. That'll happen on May 19th. Kind of making it legitimate. I don't know. We had a big conversation about crypto kind of going into its legitimate phase because it just seems that way. S&P 500. Hey, folks, if you're in an index fund, you now will start to own a piece of crypto if you didn't before. Anyway, Coinbase, best day since the presidential election. So that was definitely some outperformance there. Another one, First Solar. I've been looking at the alt energy space in a big way. First Solar, guys, up 22% in the past 5 days. This stock is up about 50%, rounding it up for you, Romain.
Thank you.
Up about 50% in the past 5 days. So it has been on a tear. This one having its biggest gain in 2 years. A couple things going on. JP Morgan coming out saying the U.S. budget reconciliation bill better than the more bullish end of investor expectations for solar, for wind and geothermal firms. Also, you had Wolfe Research coming out, upgrading the stock to outperform and announcing a $221 a share price target, stock closing at 191 and change. So really some outperformance. And one more for you, Super Micro. It's up 16% in today's session. Raymond James initiating coverage on the firm with an outperform, saying it has emerged as a market leader in AI-optimized infrastructure. And the analyst also saying Super Micro has positioned itself in a sweet spot between branded IT suppliers such as Dell and contract manufacturers like Quanta. Price target set at 41. They say the share is undervalued. Stock closing at $38.89, so almost $39 a share.
Okay, you had the easy job with the gainers. Certainly, there were some prominent decliners today. I do want to start with United Health Group. Shares dragging the Dow down today. Shares falling 17.8%. Closing at the lowest going back to February of 2021. This brings the decline from its record down 50%. The company did fall after it replaced its CEO, Andrew Whitty, with a former CEO, Stephen Hemsley. It also suspended earnings guidance. It cited unexpected medical costs and challenges with its Medicare strategy. The company's stock down about 40% so far this year. It also revised its forecast, and it raised questions about its ability to anticipate and manage patients' expenses, despite its size and reach. Also, Hertz on my radar today. Shares falling about 17%. This after the company posted a larger than expected loss in the first quarter. It was driven by a slowdown in customer bookings and a 13% revenue decline. Shares are up close to 60% so far this year. Just a reminder, Pershing Square Capital Management of Bill Ackman has amassed a nearly 20% stake in Hertz, in a part that's a bet that tariffs will drive up the value of Hertz's fleet. Once again, shares falling today by about 17%. And this is an interesting one. IGT US, International Game Technology, they make slot machines and other gambling tech. It's about a $3.3 billion market cap company out of Providence. Shares fell about 10% today, as much earlier in the session, about 15%. This after the company said its full year revenue will be at the lower end of previously issued guidance.
All right, let's go quickly to the bond market here. Not a lot happened, but what didn't happen was also quite interesting. We hit that 4% level on the 2-year and nothing, and it stayed right there, despite the fact that we got a weaker than expected CPI, which in theory could be good news, right? If inflation's less of a problem, maybe the Fed can actually cut. One would have thought that maybe yields would be lower. I also want to highlight the dollar, the Bloomberg Dollar Index, guys, jumping a full 1 percentage point. That's the biggest jump since April 11th, so right around the walk back from Liberation Day.
I just want to point out, too, when we talk about just the shift in sentiment, you were going through the decliners, Tim, and it's interesting to see most of the decliners were a lot of those defensive names that had been bid up, a lot of consumer staples, obviously healthcare, as well as some of those auto parts names. But then also the shift in sentiment to the upside, that's having a material effect as well for the IPO market. We're getting a headline right now that the fintech company Chime, which just a few weeks said it was going to postpone its IPO, now saying it's going forward. It made a full filing now with the to file on the NASDAQ. Remember, if I remember correctly, get my dates right, just maybe 3 weeks ago, it had actually said that it was not actually going to follow through with that, at least not anytime soon. But now, apparently, back in play here. So interesting shift in sentiment. Yeah,
Bloomberg pointing out kind of late last year that it had about a $25 billion valuation back in 2021. That was the peak of kind of the tech boom, and then that faded. So it'll be interesting to see as we get more details in terms of the financials on that one. In the meantime, and Romain, this is for you. I know how you travel. You like to do this kind of stuff. If you're looking for personal chefs, hairstylists, trainers, tour operators.
Is this what you learned anchoring with Romain for a second year in a row at Milken?
Well, Airbnb apparently adding some luxury services. So they're looking to offer, to pull in some more business. I think about $1 billion more in business, but 10 categories for in-home services.
Okay, so it's a services offering. It relaunched its Experiences tour booking product at an event in LA today. What it does is it has vetted providers. They offer 10 different categories of in-home services. Vetted,
so they're really checking to make sure those people are going to come and give Romain a manicure.
I was going to say I can be a vetter of the personal chefs and just eat the food and say yay or nay on those. So personally cooked meals, prepared food items, full service catering, photography, spa treatments, massages, personal training, hair, makeup, and nail appointments. I guess, Scarlett, the idea is that you go to a destination, you're not just interested in going out, but having people sort of come to you and do these things.
Absolutely. If you're going to see fewer people travel because they're concerned about the economy, the solution is to raise ARPU, average revenue per user, and count on Romain to get, spend more on services while he's there staying at a luxurious.
I would like to also point out, as somebody who got to see Carol's regimen every morning. I think she's the one who had the luxury stylist coming up to her room and helping her out.
Is that how
it takes a village? I'm just going to tell you.
Meanwhile, I just got up.
All right, very quickly here, there's a really good story on the Bloomberg.
15 miles to get to the Beverly Hilton, Scarlett.
Did you guys see the story about how rich New York City parents are being lured by elite UK boarding schools? A lot of them are being sold on this premise that for $10,000 more than what they're paying in New York, they can send their kids abroad and study at prep schools across the UK. A lot of them, of course, we're talking about folks in New York City, so they want to get away from the current political environment, climate, and put their kids in boarding school outside the U.S.
In the UK?
In the UK, yep.
Yeah,
UK countryside.
There's no issues going on in the UK.
I mean, I guess on a comparative level, and then you add on the plane fare and all that kind of stuff, then the Airbnb services, and all. I mean, that 10 grand is really looking at 20, guys. Let's be honest.
I was just going to say, man, let's just spend more money. For education.
I don't think we were the target audience.
Definitely not. All right.
That reminds me, I need to write a check.
So maybe we are the target audience.
Hey, listen, they'll remind you. I'm just going to tell you.
They will remind you.
Every time I write that check. How many zeros?
All right. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Folks, we call up the closing bell. Alex is heading out. Scarlett and Romain continuing over there on Bloomberg TV, and Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
A lot more coverage coming up here on Bloomberg Television, including a closer look at the energy sector as President Trump makes his rounds in the Middle East. Arjun Murti, partner over at Veriten, is going to be joining us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. Another risk-on day here for the markets. Not quite the monster gains that we saw yesterday, but sizable to be sure. An S&P 500 flirting with that 5,900 line. Remember, yesterday it did close above that 200-day moving average. And a lot of technical strategists saying that all the major resistance points at least out of the way until you get to around that 6,100 level. Goldman and quite a few other strategists out there now starting to raise their S&P 500 targets over the next 3 and 12 months. Just a few weeks after lowering those targets. It was a risk-on day, and you see that reflected in Bitcoin, which continues to rally, now holding firm above that 100,000 level. Oil and gas stocks having a phenomenal day. The XOP ETF that tracks those names on a 6-day run right now. But of course, not all was rosy out there. Healthcare stocks really took it on the chin as a group, down about 4%, and that was largely because of one big name.
Yeah, and we'll get to that in just a second. But just to follow on your heels on Bitcoin rising today, Coinbase adding 24% for its biggest gain in about 6 months. This is after the crypto exchange will be added to the S&P 500 after the market closed on Friday, so before the market opens next Monday. The company will replace Discover Financial, which of course is being acquired by Capital One. And Romain mentioned the healthcare space. One big mover is United Health, down about 18% on the day. At one point, it had fallen as much as 25%. Either way, it's the worst performance in the S&P 500. The company unexpectedly replacing its CEO with the current chairman and former chief executive Stephen Helmsley. The company also suspended its earnings guidance after initially just a couple of weeks ago cutting its annual outlook, which itself was a fairly rare move for a business that's known for forecasting very conservatively. So a lot of talk about how it needs to come up with a new strategy for Medicaid. Now, our top story this hour is with trade tensions easing, what's next? Investor sentiment is improving following yesterday's announcement of a 90-day truce between the U.S. and China. Plus, today's news of Nvidia and AMD's plan to supply semiconductors to a Saudi Arabian AI company. Now, later in the program, we're going to look into how Republicans in the House are plowing ahead with their draft of the president's big, beautiful bill that includes extending the 2017 tax cuts as well as raising the debt limit, while the pharma industry grapples with how to comply with an executive order to lower drug prices for Americans. All that coming up. Romain?
Yeah, we're going to talk a lot about that. Of course, yesterday, trade was what really drove the rally. Today, it was actually economic data. U.S. inflation, that CPI report, rising less than forecast in April. And that actually points to a muted fallout from the tariffs so far. Stuart Paul of Bloomberg Economics writing that the report shows that the inflation impacts have to be considered side by side with the indirect impact of services. And given the relatively higher importance of services in the CPI, disinflation in that sector could offset inflation in goods. Stuart Paul joins us right now to talk a little bit more about this. So the yin and yang between goods and services. Explain.
Well, so we do see a little bit of tariff impact when we go line by line really deep inside the data. So we see appliance prices rising. We see electronic goods and sort of the input and some of the more minor electronic gadgets. We see those prices rising. But then when you look at things like travel services, hotels, airfares, those services prices are really falling off pretty dramatically, and that is weighing on headline inflation most.
Why is that dropping, though? Because I heard a couple different takes on this, and one of the takes that caught my attention was that's not necessarily a good sign because those prices might be falling because there's just less demand for it, or is that reading too much into it?
That is part of it, right?
Yeah.
So there's some demand retrenching. There's less flows through airports, and that's starting to show up in prices. Travel season, you would typically, at least in the spring and into the summer, you would expect to see some people who are going to more adventurous locations and trying to enjoy a little bit of sun, but they're just not going out and spending, and we expect that to also show up in the retail sales data later this week.
And we should point out, too, I mean, the summer travel season, at least here in the U.S., ostensibly kicks off in a couple weeks on Memorial Day.
Yeah, maybe even earlier for some people. You know, now that we have this 90-day reprieve between the U.S. and China, according to you guys at Bloomberg Economics, that may cause a lot of companies to restock during this window, creating congestion at ports that could lead to higher prices. Is this a scenario that is being reflected in forecasts?
A little bit, but not entirely. We haven't seen the GDP data, the GDP forecast move, for example. When the 90-day reprieve was announced, there was this part of me that started thinking, it's actually a little bit ironic. There's this loosening of trade tensions that could actually result in worse printed economic data. You could get firms trying to pass through higher input costs more because you don't have an outright, essentially, ban on trade with China. So you can try to see some of those Chinese goods have their input costs passed along to consumers. And also, with that restocking of inventories and that restocking of imports, you should see some additional drag showing up in the GDP data. It's a little bit counterintuitive, but the printed data could look worse.
All right, well, we'll look ahead to see if that does indeed pan out. Stuart, always a pleasure. Thank you so much. Stuart Paul of Bloomberg Economics. Now, sticking with today's CPI data, within that report, energy costs climbed 0.7% last month, contradicting the president's claims that those expenses are declining. Joining us now with his outlook for oil prices and energy demand as a whole is Arjun Murti. He is partner of energy macro and policy at Veriten. Arjun is a former equity analyst on both the sell side and the buy side. Arjun, thank you for joining us. Now, we should note within that CPI report, gasoline prices ticked lower on a seasonally adjusted basis, but natural gas prices jumped. I wonder overall, when you look at WTI and how it performed in the month of April, down about 17%, to what extent can President Trump claim credit for that decline, for the muted price action since?
You know, I think it's been two factors. The trade tensions, which you've noted are easing, that was clearly a factor to people becoming concerned about the future trajectory for demand. But the bigger surprise, aside from so-called Liberation Day, was OPEC's decision to more quickly unwind their production cuts, which came at the same time as this tariff news. And those two events, I think, were the biggest drivers of oil prices pulling back over the past month or so.
Okay, so I'm going to take the bait here. Why is OPEC Plus ramping up production now? What is the goal here, or what is the thinking?
I think this is such a key question. Since the bottom in COVID, which was 2020, they have had a very strict strategy to manage oil inventories to the low end of the historic range, and they've both raised but more often cut their production to keep inventories in check. And suddenly, since the election that we had in November of last year, President Trump came into power. He has very vocally called for lower oil prices. He's called for drill, baby, drill. We've seen OPEC react to that. Now, I've called it pump for Trump. You can somewhat debate their exact motivations, but I'd argue that it is not a coincidence that with President Trump in power, and especially with the tariffs, you've seen them more dramatically bring the oil back into the market, I think to help curry some favor and to bring oil prices down in the near term. And it's probably been the biggest driver of the fall in oil prices besides the tariff concerns.
Well, I'm curious, though, just sticking on that OPEC side and their pumping, though, also how much of that has to do with them also trying to send a message to some of their OPEC plus members who, let's just face it, haven't necessarily been abiding by previous agreements?
I respect that is a different viewpoint that some people have. But if you take Kazakhstan as an example, it's long been known that they were going to bring on this expansion project. So the idea that suddenly, after 4.5 years of, quote, supply discipline, OPEC's now going to be mad at Kazakhstan, I don't find it to be super credible. You've also got clear evidence from a lot of U.S. shale producers that unlike 5 years ago or 10 years ago, they're all talking about plateauing shale. They're all starting to talk about where do we go next to find oil supply. So shale is much more mature. We've always known some of these other projects were going to come on. I personally don't buy that was the driver of OPEC's production increases.
Is there a sense here, at least back here in the U.S., in terms of the ability, or at least I guess having the green light to drill more? I don't know if the ability is necessarily there, but do the U.S. oil companies, and I'm talking pretty much about the oil majors, do they really want to? I mean, I was always under the impression that, at least based on what we have here in the United States, most of them were already kind of tapped out. Or is there more a slack there, if you will?
Yeah, Romain, the big problem with industry last decade is they did, quote, drill, baby, drill. And it led to too much CapEx, very poor returns on capital, and shareholders said, I want no part of it. Really, since that COVID bottom, you've seen the newfound discipline amongst this industry that used to only exist for the largest major oil companies. You're seeing now a broad swath of independents say we're going to prioritize profitability and returns on capital and returning cash to shareholders over simply drilling. So on the one hand, I think they will all welcome a regulatory background that says we're going to be supportive of infrastructure. We're not going to yell at your industry and say you have to go away within the next decade or so. But on the other side, I'm going to say it's going to be the focus on shareholder returns that is really driving this sector. So we have not been expecting these companies to ramp up activity.
Okay, so that's a response in terms of managing their cash flow and their finances. But operationally, how did they respond? Excuse me.
Yeah, it's funny. You're seeing them as recently as these Q1 earnings calls, which have just ended. You're seeing industry more proactively respond to this pullback in oil prices we've seen with a lot of uncertainty. Maybe the tariffs are going to ease. We're seeing some signs of that. Maybe demand will hold in there. But despite that, the companies are being much more proactive about ensuring, let's make sure we have good balance sheet health. If we need to ease up on some activity in the short term, let's do that first. And if oil prices surprise to the upside, we'll benefit from it. So you're seeing a faster operational reaction than you've seen in past cycles to this pullback in oil.
All right, Arjun, really got a really great conversation. We got to get you on to talk a little bit longer about this. Arjun Murti is partner of energy, macro, and policy at Veriten. Now, we do want to get you some updates here in the earnings space. American Eagle Outfitters, the apparel brand, out with preliminary results for the most recent quarter. But the key headline here is that it is withdrawing its guidance for 2025. It, of course, cites some of the issues around its operating losses, reflecting what it calls higher promotional activity in the quarter, as well as some inventory charges as well. Also says that its merchandising strategies not necessarily driving results in that space as well. Those shares one of the biggest decliners in the after hours trade. That company, Scarlett, expected to report earnings on May 29th. The preliminary results are out and they are down.
All right, good thing to keep an eye on here as we await more results. Formal results from the big retailers. Now, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. A comeback for one of the biggest names in baseball included. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Brazil's President Lula meeting with China's Xi Jinping today. The pair signed more than 30 agreements for Chinese investments in mining, transport, infrastructure, and ports. So remain in a bifurcated world. It feels like Brazil is certainly picking Team China, even though Lula says he doesn't want to choose sides.
And this is the real backstory, I think, going on between the U.S.-China trade relations. You have the U.S. trying to strike its own sort of individual deals, but so too is China. Be interesting to see how all of that works out. I'm keeping an eye on Mr. Beast. You heard of him? He's a big star, Scarlet Fu, on YouTube.
I'm not a teenager, but I think your son has and my son has.
Yeah, but do you like jerky? Because, well, he's got a partnership with Link Snacks to create a line of jerky, extending his foray into food products, which includes chocolate brand and, of course, that Feastables and Lunchy kit, which didn't go over so well.
It didn't go over so well?
Yeah, I'll leave it at that, not to get myself in trouble.
Well, his Beast Industries generated sales of $250 million last year and profit of $20 million plus.
The guy is a juggernaut.
Clearly. All right, rounding out our top three is Pete Rose, because he, along with shoeless Joe Jackson, are among the former baseball players reinstated by the MLB. So this now makes Pete Rose and Joe Jackson eligible for election into the Baseball Hall of Fame after initially being disqualified.
This is amazing. This headline actually just crossed the wire from the Associated Press just moments ago here. A lot of people really did not think we would ever see Pete Rose in the Hall of Fame. Of course, this does not mean he's going in just yet. But remember, now he is finally eligible. This was a long-standing rule, or excuse me, there was they did away with the long-standing rule about lifetime bans, basically saying that after that person has passed away, and Pete Rose passed away back in September, that ban is automatically lifted, now giving voters a chance here to decide whether he should go in the Hall of Fame. And if that vote is going to be based on his athletic abilities, it's a lock.
Well, MLB Commissioner Rob Manfred said that President Trump has also talked about this with him, and Trump had actually written on Truth Social that he was going to sign a complete pardon of Pete Rose.
Wonderful.
So he has his take as well.
There you go. Charlie Hustle. Get him in the Hall of Fame. He was a 5-time All-Star in 17 in 5 different positions, Scarlett. How many positions do you play?
Complete player.
With the help of the people of the Middle East, the people in this room, partners throughout the region, the golden age of the Middle East can proceed right alongside of us. We will work together. We will be together. We will succeed together. We will win together. And we will always be friends.
President Donald Trump speaking at the Saudi Investment Forum in Riyadh, kicking off a big trip to the Middle East. The president and the Saudi Crown Prince Mohammed bin Salman touting a pledge for $1 trillion in commercial deals. Joining us right now to discuss what's going on in the world of Washington and beyond is Tobin Marcus, head of U.S. policy and politics at Wolfe Research. And Tobin, I'll bring us back to Washington in just one second, but I do want to start in Riyadh here. A president, of course, that fancies himself as a deal maker. And this week, at least, we have seen at least the contours of some potential deals, whether it is a potential détente on U.S.-China trade tensions or these investments that he appears to be trying to drum up from the UAE, from Qatar, and Saudi Arabia. What do you make of it?
Absolutely. The deal with China is far and away the most important of the deals that he's negotiating, either in a tariff context, or of course we have talks ongoing with at least 17 other countries, or these foreign investment deals. I think the White House has been very focused on messaging the flow of investment commitments coming into the country, both from U.S. companies and from folks who are engaged in foreign direct investment. We'll see exactly how much of that materializes. Always a lot of concerns about exactly how much of that is incremental. But that's a longer term story. The tariff relief we got from China is a very near term and very impactful story for markets.
I was just at the Milken Global Conference, and there were several members of the Trump administration there with a relatively unified message. And it was really this idea that when it comes to tariffs, you have to look at it holistically. The idea that the president is also going to pursue deregulation back home. He's going to pursue tax cuts, balancing the budget, and other measures that will somehow, at least in their view, balance out whatever negative effects we have from tariffs. The tax bill, a key pillar of that, is trying to work its way through the House right now, though it does appear, at least on the surface, not every Republican is on board with this. Where does it stand?
So it's absolutely a contentious process, and it was inevitable that there were going to be bumps as we get towards the end. I think the House process is going better than most observers would have expected. They're moving into the committee consideration of both the tax and Medicaid pieces this week with significant confidence. So I think there's a good chance they stay on track. There's certainly, SALT is an ongoing question. They're going to have to mollify the SALT crowd. Medicaid has been very thorny throughout this entire process. But I think for the most part, they've done a pretty good job keeping the moderates and the conservatives on the same page and gotten the moderates to agree to, on paper, some pretty big numbers on Medicaid cuts and IRA rollback.
Right. But I mean, as you said, it's on paper. And I want to go to those SALT deductions because the bill raises the cap, but not enough to appease those lawmakers from New York, New Jersey, and California, especially since Republicans can really only afford to lose 3 votes. So how big of a sticking point do you see this being?
It's a big sticking point. I think they are the ones who are making the most noise at the moment, more so than the conservative fiscal hawks complaining about insufficient Medicaid cuts, more so than some of the moderates who've been raising concerns about going too far on either Medicaid or IRA throughout this process. That being said, there are a relatively small number of these members who are focused on SALT. And I think there's only so much that they can realistically hope to get for in an environment with a lot of fiscal constraint. I think the numbers that they're asking for in terms of taking SALT, possibly the cap into the triple digits, possibly incurring, $600-800 billion of costs are, disproportionate to how much leverage they have when you stack it up against the rest of the items in the bill.
In your note, Tobin, you also talk about how the Joint Committee on Taxation needs to release a score on this bill. Does that matter when we already know what the votes will look like on this bill?
So the JCT score came out earlier today, and folks are getting their heads around that. I think it was a good quantification of exactly what we're looking at on IRA, exactly how much, from a stimulus perspective, we can expect some of these temporary tax cuts on both the individual and the corporate side to inject into the economy. I will say that Congress cares a lot about these scores to an extent that is not always appreciated in markets. We certainly get a lot of questions about the extent to which maybe the bond market's going to be shaping when they're thinking about deficits. Generally, it's much more the case that these CBO and JCT scores are the things that are kind of shaping votes. So certainly they're going to want to have those numbers in hand. And the fiscal conservatives, for sure, will want to know what they're walking into in terms of deficit numbers before voting for this. Do
you have any sense here that this will actually potentially get done by Labor Day, which is just less than 2 weeks away, if you want to mark it on the actual holiday? I mean, that's what Speaker Johnson said. I mean, Congress, at least in the past, doesn't seem to move that fast.
Yes, Congress historically does not have a great track record of hitting timelines. I think the House version of the bill might get off the House floor by Memorial Day. The overall enactment of the bill getting to President Trump's desk has no chance of happening by Memorial Day. We are thinking of that as being a July type of item, where the optimistic case is that it gets done by July 4th. The somewhat more conservative case is that it gets done by the end of July in advance of the twin deadlines of the August recess and the debt ceiling X date, which really is the most immovable forcing event that's going to make them get this done.
Can the House chew gum and walk at the same time? Do they have the capability to do anything else while they're working through this bill?
Usually not. Congress typically not very good at multitasking. The Senate is, of course, advancing judges and nominations while the House kind of churns its way through this bill. But then once this bill drops on the Senate side, assuming the House can get it voted on next week as they're hoping to, then this will consume all the oxygen on the Senate side also. But this is kind of the only game in town. It's the vehicle for the entire Trump administration and congressional Republican agenda. It is the thing they should be focusing on. They put a lot into it, and the question now is, can they get it over the finish line?
All right, good stuff. Thank you so much. Tobin Marcus is head of U.S. policy and politics at Wolfe Research. Romain.
All right, some breaking news. This involving Nvidia CEO Jensen Huang. The latest compensation in the most recent year is out. And we're now learning that he's set to make about $49.9 million for 2025. Of course, this is total comp that includes stock awards and other factors that boost that amount. Nevertheless, the total comp at $49.9 million would be a huge jump from the $34.2 million that he was due to make for 2024.
Yeah, that would be a 46% increase from 2024. And by the way, the stock for Nvidia up about 171% in 2024. So yeah, there you go. All right, for more on the U.S. economy and the fiscal outlook in particular, let's turn to a conversation now with Citadel founder Ken Griffin. He spoke with our Sonali Basak for an episode of the upcoming series for Bloomberg Originals, Bullish. Take a listen.
What's clear is that the numbers that we talk about in America are almost incomprehensible. Billions and trillions. I mean, it's just unbelievable how big government in Washington has become. And I think one of the areas that the Trump administration is focused on is how to reduce the scale and scope of spending here in the United States, whether it's the efforts at DOGE or the debates that are happening right here, right now as we speak, about, for example, Medicaid and the cost of Medicaid to the states. The Trump administration's really thinking about how do we help to solve our nation's spending problem. And then at the same time, They're grappling with what is the right tax policy that helps us to pay for the promises that we've made to the American people, and yet ignite the maximum amount of growth that we can achieve in our economy. Because when it's all said and done, the only way the United States will solve for the promise it's made to its people is for us to far more rapidly grow our economy.
What role is deregulation going to play in that?
Well, I mean, deregulation is clearly already one of the huge accomplishments of the Trump administration. And why do I say that? Because the onslaught of new regulation has stopped. That in and of itself has been incredibly powerful for corporate America, the ability to focus on growing your business again without worrying about what new rules can be imposed upon you from Washington. Now, having said that, the efforts to deregulate are going to be more slow because it takes time to re-underwrite why was the regulation put in place to start with. How does this regulation serve the interests of the American people? It takes time to thoughtfully deregulate our economy.
Now, your companies have a footprint all over the world. Are you seeing investors hedging against U.S. instability, diversifying away from U.S. stocks or even U.S. treasuries, given the changes and the uncertainties that still exist around them with the administration?
I think there's been two very strong realizations by investors around the world. First, there was a bit of a knee-jerk reaction to pull back from the United States, to be anxious about investing in America, given the stance and changing stance we took in areas like trade. But then there's also just a realization that no country in the world enjoys the rate of innovation and commercial development that we enjoy here in America. And so you have these two competing arguments that investors around the world are grappling with. Is the United States going to be a reliable ally and economic player in the world markets? And compare and contrast that with the reality that if you take a step back, no country in the world, other than perhaps China, comes anywhere close to America in terms of the rate of innovation and creative energy that goes into growing our economy.
Citadel founder Ken Griffin speaking on Monday. Some excerpts from that interview in its entirety will be aired at some point later in the future right here on Bloomberg. But we want to stay in the world of politics and the intersection, of course, with what's going on in the market. Just yesterday, President Trump talked about how he's looking to slash drug prices for Americans by lowering them to the prices that are charged in other countries. Despite this, drug makers saw the executive order as weaker than feared. For some firsthand perspective on this, let's go to the CEO of Currax Pharmaceuticals. His name's George Hampton, and he joins us right now. George, kind of explain this, because I was very confused by the announcement yesterday. I mean, I get the broad contours of what he's trying to do, but why was this received, I guess, somewhat poorly by the industry?
Well, I think it's, first off, it's well-intended, right? I mean, we need to get pharmaceutical prices down in this country, unquestionably. What I think is missed in this bill is you're trying to compare the American system to the European system. And what we have here in the U.S. that Europe does not have are layers and layers and layers of middlemen who extract price out of the middle of the system, right? Now, in Section 4 of his executive order, he does try to address that, which could be interesting. But for the most part, these systems are comparable.
So give me a sense here, George, in an ideal world, or an ideal United States, I should say, what would you want the president to do? Is it sort of finding a way to sort of tamp down those middlemen? Is there something in the regulatory process that can maybe be smoothed out that would make things a little bit more favorable without necessarily having to revert to, I guess, what he envisions is more of a parity with the European style system?
Yeah, I think the parity would be difficult because of the difference in systems, right? But I think, in Section 4, he kind of imagines a world without PBMs where pharmaceutical companies can sell direct to patients. And I can tell you, we at Currax, we have a program called Currax Direct. We have the #1 branded anti-obesity medicine in the country. And we've been selling direct for $99 a month, direct to the patient's house for the last 5 years. Our list price is $625. So that kind of puts it in scale of what it costs really to be layered with middlemen between the list price and what it actually costs to deliver the medicine.
If the administration does force or require U.S. drug companies to match the price of their drugs in Europe, what's the ripple effect going to be? I mean, what does that unleash in terms of like a sequence of events?
I think there's two things, right? First, you have to decide whether or not you still want to sell your product abroad, right? Because it could be unaffordable then to do so. The second thing would be really to take a broader executive order and look more closely at the middlemen. I think if we take a step back and we look at a very recent case, the CVS Caremark recently excluded Lilly's GLP-1, right? Lilly's GLP-1 is the market leader. It has better head-to-head data, and it's clearly the least expensive medication of the two GLP-1s that are in the marketplace. And they excluded it and benefited the more expensive medicine. And so we have to find a way to stop practices like that in the marketplace to overall bring down prices.
What kind of demand, how have you seen demand shift for the obesity treatment that you offer in light of these changes that you just described?
I think it's probably too early to see that, but I can tell you 70% of our business now goes direct to patients. And so it's a very popular channel. It's a channel of distribution that is affordable to the patients, and it basically excludes the middlemen, right? And so we're able to do it at a much lower price. Lilly has a Lilly Direct that I know is becoming more and more popular. So there's ways to do this without all the middlemen.
So as we sort of move forward, George, I mean, we obviously don't know the contours of how this executive order and the necessary sort of regulatory process is going to play out. But it gets to this sense here that you do at least have an administration and an HHS that does seem to be hyper aware of some of these issues. Do you have confidence that something amicable for everyone involved will be reached, both for the industry as well as for the consumer in all this?
Oh, I absolutely think so. I mean, there's plenty of room if we start really chipping away at the system that we've had in place over the last, I'd say, two decades, and we start looking more towards a direct distribution model where patients can access the medicines at a far more reasonable price. That would trickle down to the government as well. So there's plenty of room here for us to be able to do things with price in pharma.
George, I got to ask you, as someone who has more than 30 years experience in the pharmaceutical and biotech field, not just with your current company, but with another company, with other companies as well, the government's push to reduce government funding to universities, including Harvard, for instance, cutting over 700 research grants from the National Institutes of Health. What does that mean for your industry? Perhaps not immediately, but down the road, in 5 years, in 10 years from now?
Well, if you break down where most of the medicines come from, they come from the pharmaceutical research itself, right? Smaller private investments in companies that eventually develop something new and unique, and then typically a larger strategic company would decide to acquire that product and then bring it to market. Obviously, some medications do come out of universities, but it's by far a much smaller number than what is developed inside of pharma. So will it create an issue? It could. I think what could create more of an issue is if we are forced to, I think, match European prices in a system that doesn't match the European system.
All right, George, thank you so much. George Hampton is CEO of Currax Pharmaceuticals. Romain?
I want to turn our attention right now to shares of Aurora Innovation. This is the company that's trying to make the self-driving truck. Shares down 20%. This is after Uber actually came out and said that it plans to sell about $1 billion in convertible notes, but those notes will actually be exchangeable into shares of Aurora. Remember, Uber is a big investor in Aurora. Of course, this is basically a dilutive type of measure should it actually go through, and that's why you're seeing the shares move over there. A 20% drop in those shares for the company that makes those, or is trying to make those self-driving trucks. All right, when we come back, we're going to take a look back at this day in history, Scarlett. You're a music fan, Scarlett?
I am.
Well, an interesting day today. About 9 years ago, where the music industry did find an unexpected lifeline in an unexpected business model facilitated by an unexpected album from Chance the Rapper.
Really?
I'll explain when we come back. This is Bloomberg. All right, earlier today, Tencent Music reported earnings that beat estimates, but the eye-popping number was the 123 million paying users on the streaming platform and the tripling of its profits. Now, Tencent, along with Spotify and Apple, dominate global streaming music, which in barely 10 years has grown from next to nothing to a $45 billion industry. And that brings us to an important milestone in the evolution from physical music to downloaded music to streaming music. Because it was on this day, May 13th, 2016, when Chance the Rapper released his coloring book mixtape exclusively on Apple Music for free, with no major record label involved. There was no CD to cop, no MP3 to download. The mixtape still debuted at number 8 on the Billboard charts. It was the first streaming-only music album to crack the top 200 and the first to surpass the digital equivalent of 500,000 albums sold. It was a game changer, proof of life for a new business model. And the change was swift. Just a month after Coloring Book, the National Academy of Recording Arts and Sciences agreed to accept nominations of music released only in streaming form, the first time that it ever happened. And in the ratification of that decision, Coloring Book a few months later became the first streaming-only album to ever win a Grammy. Now, it was a coup for Chance the Rapper, but it was more of a lifeline for an industry that had grappled with 2 decades of decline. By the end of 2016, U.S. music sales were up 11%. And for the first time, streaming accounted for the majority of that revenue, 51%. And it's only grown since. Here in the United States alone, paid and ad-supported streaming services, as well as sales through digital radio and social media apps, that brought in a record $14.9 billion in revenue last year, or about 84% of total domestic sales. By comparison, revenue from physical formats accounted for 11%, and that was mostly vinyl records. And as far as digital downloads, that's pretty much a thing of the past already, accounting for less than 3% of market share.
Boy, I feel like it's such a relic from the past. I live with someone who does collect vinyl records, and I think I did digitally download something not so long ago, so joke's on me. All right, let's take a look at how markets closed on the day. You had stocks extending yesterday's rally, pushing the S&P 500 and the NASDAQ 100 above water on a year-to-date basis. Cooler than expected CPI certainly helping. Within the chip sector, 27 of 30 members in the Philadelphia Semiconductor Index rose as Nvidia and AMD will supply chips to a Saudi Arabian company for a big data center project. And the dollar continues to retreat from a one-month high.
It'll be interesting to see whether any of this gets unwound. Not so much what's happening in the equity market, but when we talk about the moves in yields, the moves in the dollar, and of course that big drop in the VIX. I mean, as a lot of people said, very encouraging signs this week given some of the break-in tensions, but of course not out of the woods yet.
We still have 88 days to go before the truce expires. Yeah, there you go.
We're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. All right, 2 straight days of gains for global markets. Let's see if we can make it 3, and a lot's going to depend on some of the economic data we get in the morning.
Yeah, and it starts overseas in Europe. Germany and Spain released their CPI numbers. We know that the ECB has been in easy mode.
Absolutely, and then back here in the U.S., we do get those weekly mortgage application numbers, and we get a lot of Fed speak tomorrow.
Yeah, you've got Waller, you've got Jefferson, you've got Daly, and for the most part, you've got cooler than expected inflation, and the soft data should start to improve a little bit here.
It'll be interesting to see if they can say anything that could move the markets. We do get a couple of interesting earnings, including Cisco, which was in the news today.
Cisco is in the news today. CoreWeave also coming out with its first earnings report since its IPO.
And speaking of Cisco and that deal, of course, over in the Middle East, Trump's visit to the Middle East continues.
Qatar's next, right?
Going to Doha after that great night in Riyadh. We had a great night here with you in New York. Stick around. Balance of Power is coming up next.